There's a saying we have in real estate: it's not a good deal unless it's a good deal for every party involved. The biggest question I get when I start talking about seller finance is, why would a seller want to seller finance me their property?
That is a really good question. I could think of quite a few reasons why somebody would want to.
Interest rates have gone up in the last few months. And with interest rates going up, values have not dropped. So we had this 2.5 year period where values just kept skyrocketing with low interest rates. And now all of a sudden interest rates have gone up, values aren't dropping. So you've got expensive homes that have a huge interest rate attached to them, and what that's doing is it's making payments outrageous. If we were to go buy a rental property right now, we would pay a whole lot more because we'd have a 6-7% interest rate, versus if we went out and found somebody that was in a situation where they wanted to seller finance their property to us. Maybe they bought it 2-3 years ago when rates were at 2%. Now we end up with a 2% mortgage, and and it's a lot easier to cash flow on a 2% interest rate than it is on a 6% interest rate, just saying.
All of our rentals are structured this way, all of them. So we haven't actually picked up a good rental in a hot minute. We just haven't. And the reason is because we moved with the market, right? Guys, if you're educated, and that's what we always, harp on, being educated allows you to just adjust. Just adjust. Yeah, there you go. Simply recognize where the market is changing and pivot. That's it. It's as simple as that. You don't need to overcomplicate it. If the market is telling you that it's a seller finance market, it is. So it was a seller's market for the last 2.5 years.
Yep.
Before that, it was a buyer's market. When I got started in real estate, it absolutely was a buyer's market. There's an interesting pivot, though, that will happen in exactly where we're at right now, which is because the market's not dropping. People still want what they want for their property.
As a buyer, whether you're an investor buyer or a retail buyer or a buyer's agent, you have 5 things that you can negotiate in seller financing that really allow you to give the seller what they want, and you get what you want as well. Now, let's say your desire is, as the buyer or the buyer's agent, is a low payment. So what we can do is we can manipulate the other things. Purchase price is only one of those things. We have the amortization time, we have the balloon payment, we have the down payment, and we have the interest rate. So those 5 things we can play with so that both parties get what they want. Notice that the sellers want the purchase price. We can give that to them. The buyers want a low monthly payment. So we can mess with the down payment. We can mess with the interest rate, right? Normally the interest rate, if there's an underlying mortgage on the property already, you're gonna have to give them an interest rate that's higher than what they're currently paying. So that may not be something that you can play with. But something that a lot of people don't think about is the amortization time. 30 years is the standard for banks, but in seller financing, we're not working with institutionalized banks. We're working with individuals, right? So if you wanted to, you could say, hey, look, I wanna get my payment as low as I can. I'm gonna give you the going interest rate, 7%. I'm gonna give you $50,000 more than what you're asking for the house. I'll give you $1,050,000 for the house. But we need to make the amortization time 40 years instead of 30 years. What that's going to do is that divides the monthly payment up by 40 years rather than by 30 years, thereby lowering the monthly payment. Now, that 5th thing, the balloon payment. A lot of times the seller who's seller financing the property to, they don't want you to go the full 30 years or 40 years to pay this thing off. They want you to go maybe 5 or 10 years, right? So you might have a balloon payment in 5 years, which just simply means that you have to pay off the loan, which means you either have to sell the property or you have to refinance it in a traditional mortgage. That's great. That means you've got 5 years to figure it out. Fantastic. Take it, right? But remember that you have all of those variables to get both parties exactly what they want. And that's something that's unique in real estate investing. You can't really do that with a flip, for example, that you're buying cash, right? But with a seller finance property, you can mess with the amortization, you can mess with the interest rate, you can mess with the balloon payment, all to get both parties what they want. And that's actually pretty incredible.
Oh, it's a win-win. And that's what my favorite part about. So that's actually what got me so excited about doing real estate, is when Mitch taught me seller financing, because it just blew my freaking mind. As a business owner, it was really hard for me to get a loan to buy a house, just one house, let alone 10 or 20 or 50, right? Like, it was really hard for me. And had I known that somebody would have allowed, because I had money, It's just that the bank wouldn't give me, extra 600,000 or whatever. So I was frustrated. I was really frustrated. Had I known that somebody would have been like, oh yeah, I'll seller finance it to you, as long as it's a win-win for both sides, the answer is yes. And the big properties are going to move even faster. I yesterday was also talking to a couple, and they were saying that, it's really important for them to get the specific price that they want. Again, right, what you were saying. But also, they have an incredible interest rate. It's like 2.3% interest. So if they even charged 5% interest, are they going to make good money on that property for a long time?
Absolutely. And they could realistically charge 7-8% right now.
Oh.
Because you can charge a premium for seller financing.
Absolutely.
Because we've got those 5 areas of manipulation in the deal, we have the ability to manipulate the deal so that both parties get what they want. So a lot of times that means maybe offering exactly asking price or offering over asking price. The buyer comes in and let's say they're asking $1 million. We can come in and let's say on a traditional mortgage, you'd have to bring at least 10% down on $1 million loan, right? So we're talking $100,000 that they have to bring down, but they only have 50 in their bank account. What they would do is they'd come in and they'd say, okay, you want $1 million, you're asking $1 million. It has not sold at $1 million. So that means you're either going to have to lower your price or you're going to have to consider creative financing. We'll give you $1,050,000, and that extra 50 is what we're bringing as the down payment. When you offer above, sellers are a little more likely to work with that, those other factors that we've talked about. Whatever we work out our payment to be, we're either going to rent it out for a higher amount and make what's called arbitrage, right? Let's say our monthly payment is $2,000. We want to rent it out for $2,300. We're making $300 arbitrage. So we want to make that cash flow. So you have to make sure that your numbers work. You've got to do your due diligence ahead of time to know what you're going to be able to rent it out for. Work that math backwards to know what you need your payment to be. And then you've got those 4 other things that you can negotiate to make sure that you get your payment where you want it while still giving the seller some concessions.
Get a mortgage statement. That is the first thing you have to do. You don't know anything. You don't know how mad they're, how backed up they are on payments. They lie. People lie all day long, and you have to just keep digging. You have to just keep digging and finally figure out where they're at. I mean, Roper, he lied to me like 12 times. Like straight up to my face.
And sometimes it's not even that they're lying. They just don't know, so they make something up, right?
He knew. He totally knew. He just lied to me in my face. Anywho, finally you get the mortgage statement and he's behind 4 months, right? It's like, you could have just told me that. I told you I'd pay your back payments. Like, I told you that, right? Like, you could have said that. Anyway, with that though, there's a lot more leverage you can have once you have that mortgage statement, because you don't know what all the fees are. Like, you have no idea what you're up against, so you really can't run your accurate numbers on what you can offer them and what your monthly price and your payment needs to be. You need to know what the mortgage payment is, period, end of story. You need to know what the payoff is, and you need to know both of those right out the gate. And then you also need to know rent rolls. You need to know what the most and then the least amount that you can get for that specific property, because that's how you can figure out, okay, this is where I need to be. I need to make at least, most people, $300-400 a door. I mean, I think that's a fair number. So run the numbers, and between that, right? So don't make the mistake of being like, oh, they said that the monthly payment's $1,200, and then I can rent it out for $1,600. Woo! Like, we're good to go. Don't make that mistake.
Insurance, all sorts.
Don't make that mistake. I've done that. That's not good.
Now, you bring up a really good point with Roper.
Yeah.
And what I'm going to share with you now is a goldmine of where to find seller finance properties to buy. This is a time in the market, and we didn't have that for the last 2.5 years during the value boom. And because of the pandemic, and the forbearances, people weren't going into foreclosure. But now the forbearances are over. The market's kind of capping off. People are starting to go back into foreclosure. And when they're in that pre-foreclosure period, so what we call pre-foreclosure is that period between when the bank issues a notice of default and when they actually foreclose and take control of the property. That period between those two events is called pre-foreclosure. When homeowners are in that pre-foreclosure period, they can still sell their homes. They can still get caught up on their mortgage. They can stop that foreclosure from happening. But most people get behind because they don't have the money to make their payments, let alone catch themselves up on their payments. That's a great opportunity for you and for us as investors to go in and be their angels. And a lot of times it allows us to get these properties at a discount because we're already providing value from stopping the foreclosure from going on their credit. So we can approach these homeowners and we can say, look, you're going to lose your house anyway, the bank's going to take it, and they're going to slap an ugly foreclosure on your credit, which will stay there for 10 years. And you won't be able to buy another house for 10 years because no bank will look at you with a foreclosure on your credit. Here's what I'm offering. Because you're going to lose your house anyway, turn the house over to me instead of the bank. What I'm going to do is, as a down payment, I'm going to catch you up on your mortgage. What are you behind? $15,000, $20,000? All right, I'll write a check right now to the bank. You're caught up. The foreclosure is stopped. In addition to that, we're going to leave the loan in your name, and we're going to make the monthly payments on your mortgage on time so that it's a positive mark on your credit, which replaces that mortgage that's a negative mark on your credit right now. We're going to continue to do this, and as long as we do it on time, you're going to build better credit. If for any reason we fail to do that, we will give you the property back. They tend to look at us as angels. We stopped the foreclosure from going on their credit. Now their credit will be good in like 2 years. They can go buy a house again. And we end up with a property that we can put tenants in, that we can rent out. It becomes a fantastic deal for both sides involved. So you might be asking, where can I find these incredible pre-foreclosure properties? The nice thing is we use public record. When the bank files a notice of default, they have to file a receipt of that notice of default with the county that the property is in. So you can go to any of those counties and request those public records and then use those records to reach out to the homeowners and pitch them on the idea of seller financing. Guys, we hope you found this information incredibly valuable. Get out there and do some seller financing. This is a fantastic market for it. Now, we know that we didn't share enough information with you to make you experts, nor did we give enough to really go out and get a deal done. So if this is something that really interests you, make sure you schedule a one-on-one strategy call with us. The link's in the description below. Now, we want you to join our weekly group coaching call every Wednesday at 7 p.m. Mountain Time. The link is in the description. Mitch and Maylee Live. Make sure you're there. Incredible information that we share on those calls. Until next time, see you on the flip side.